I'm Adam Myers. I lead the distribution team at Pengana. Thank you for joining us for this webinar update with Rhett Kessler, the portfolio manager of the Pengana Australian Equities Fund. From a format perspective, Rhett will keep his prepared remarks reasonably short, probably around 20 to 25 minutes, so we'll have plenty of time for Q&A at the end. The Q&A box can be accessed from the icon on your screen, so hopefully if you have any questions, you'll enter them and we can have a really interesting conversation at the end. Rhett, over to you.
Thank you for joining us today. I will be attempting to do a few things. First of all, obviously give you an update on the Pengana Australian Equities Fund. But secondly, I'm also going to attempt to drop some interesting bits of information into the presentation about why we think certain things are happening and how certain things work. We've got quite a few nuggets of new bits of information that we've discovered both on companies, macro, as well as market mechanics. So hopefully you'll find it interesting. As Adam mentioned, I am going to keep it quite brief, and please, have conversations about the things I'm talking about if you want to at the end, so that I don't blather on and take up everyone's time. So the only thing that's changed in this slide is really we were really concerned about inflation. The picture on the front page now has, and that's not me, but somebody holding a very big nugget. It has two meanings. First of all, we think that there are pockets of real value emerging. The top 50 stocks are extremely well researched. The momentum players are well and truly busy there. Index funds are all over them. And there's a real bifurcation between valuations of those stocks and some of the others. In short, I've never seen as many 12 PE or cheaper stocks around, many of them generating quite healthy levels of cash. And then the second reference is to Evolution Mining, which has been one of our top performers. So let's jump into it. Team's consistent. I think you've seen our ugly faces enough. We've been very consistent for a long time. Quick update on the fund's performance. We continue to stay ahead on a long-term basis of our target. I will point out that graph has steepened as of late, with the cost of money going up quite a bit, from almost zero to now just over 4%. And so our target's growing at 10% on an annual basis and compounding up. So staying ahead of that is getting harder, but it's something that we've been doing for a long time. All right. First thing is we've just had a reporting season. It feels like a lifetime ago. It's this fire hose of information that comes out. And I've just got a few points. I'm going to mention a few things so we can come back to these in questions if you want. So what are our learnings? First of all, it absolutely this year confirmed the importance of efficient accounting or management reporting systems. And by that, I really mean that those companies reporting early tend to have better results on average, and those reporting really late in the reporting season generally have worse results. And that was no surprise this year, again, that the better companies that were able to respond quicker, have good systems, very on top of everything, did exceptionally well. And there was a real skew towards, or a bias towards, the negative results later on. The second surprise, I guess, was domestic consumer resilience continues. And this was evident in a number of different places. One of them was the banks. Bad debts continued to be very subdued. Secondly, discretionary retailers actually did very, very well, particularly the better ones like JB Hi-Fi's, the other one, Super Retail, etc. Thirdly, the average, and everyone expressing surprise about it, is that the average level of stress, property and maybe hospitality aside, continues to be very low. So there's still a lot of money going around. I always try to throw in the fact that we track the pokie machine revenue series and been doing it for about 30 years now. Victoria has been a little subdued, but the rest of the country is doing exceptionally well and hitting record levels of spend on pokie machines. Not a great piece of social information, I agree, but certainly from a commercial perspective, it tells you there's cash in the system and still doing really well. Interestingly, one of the things aside is that Victoria seems to be wearing the brunt of all the bad news. And that's really a hangover from the way they dealt with the COVID issues, ran up a lot of debt, and governments, they've been forced to respond by jacking up all kinds of property taxes, and made life quite difficult for business there. Overall, earnings growth in general, in spite of the resilience, was quite subdued. And that's mainly as a result of we saw very high operating costs and very high finance costs. And that takes me to my next point. Higher interest rates continue to impact earnings. It does appear that most analysts get down to the EBITDA line and then kind of stop. And so typically analysts have been very, very poor at predicting cost of money impact on the balance sheet and the income statement. And a lot of the surprises were in that area. We've had lots of CFOs, say to us, geez, are we supposed to guide on a purely mechanical interest rate calculation? The analysts just can't seem to get that right. So there was quite a few negative surprises around that area. We like to think we're quite good at that. Cost of money, as you know, is quite important for us. And then I guess point number 5 was that the outlook. No one is going out on a limb to predict stronger earnings. Everyone's talking about a tough time. No one's quite sure as to how long the consumer can remain resilient in spite of tax savings coming up. Everyone's hoping for interest rate cuts. I don't think they'll happen at all domestically this year, but hopefully sometime next year. And so a lot of the performance that we saw during reporting season was around PE expansion rather than very strong earnings growth. We had quite a few winners. As you can see, that line was quite long, particularly skewed towards the first half. And was largely driven by a combination of on the one hand, very pessimistic valuations due to market being concerned about certain things, but then also having quite good results, which in our view validated the fact that we were there. So ResMed, no one was ever going to buy another sleep apnea machine because GLP-1s was going to make everybody skinny. That certainly didn't materialize. If anything, counterintuitively, the GLP-1s have driven enormous amounts of people into the sales funnel of having sleep tests and therefore being prescribed with sleep apnea machines. Likewise, Telstra, there's a situation where when they got rid of their compulsory CPI price increase every year, everyone took that to be a negative, and the share price was sold off quite heavily. And then the results proved out that it actually gave them real pricing power because the prices they put up were greater than inflation, and they could pick and choose where they wanted to go on that. So both ResMed and Telstra, I'll mention them first, they were big winners for us. There's another feature that we've been leaning in to these situations. So in the past, well, I'll come to that bit later. Evolution Mining, JB Hi-Fi, Super Retail. So Evolution Mining is just gold price issue. They're still the lowest cost gold producer. They've sorted out what's happening in Canada. It's a small part of their portfolio that was a negative, still is a negative. But the sheer size of their gold and copper production is really driving what is quite a cheap stock higher. JB Hi-Fi and Super Retail, as I think I've said before, we really didn't feel that that optimistic about the consumer, but JB Hi-Fi and Super Retail were priced for disaster. Full balance sheets with no debt, in fact, quite a bit of cash. The and on sub 10 multiples, even if they gave back a lot of their earnings that they generated during COVID. Stockland is interesting. We have a view that it's quite a reasonably priced business, but the combination of the CEO plus their new business model on creating housing has meant that stock's done very, very well. We like the CEO. The kind of deals he's been doing has been superb, very commercial. And then obviously there's Lend-Lease, which sort of is a carcass that everybody's feeding off as they desperately try to right-size their business and their debt. So Stockland has been a major beneficiary of that. Aristocrat we've spoken about before, and then MGH, probably most of you don't recognize that code, but that's Mars Group, which is a building materials business based in the regions plus metropolitan Melbourne. It's done exceptionally well. Still very cheap stock, and we continue to be building quite a big position there. On the losers side, I've listed the three that we, in light of the reporting season, we got wrong. We think NIB and SG Fleet, the investment thesis are very much intact. On NIB, the earnings were definitely affected by very cautious provisions, and the stock has been sold off. It's currently, we think, extremely attractive. And on SG Fleet, excellent results, return on equity about 15%, escalating to 20%. They released a lot of capital, paid a special dividends. A special dividend, gave a very cautious guidance. And on both of those stocks, we are taking the leaning in position. Now, what I mean by that is, importantly, maybe a year or two ago, when you found opportunities, you had to act really quickly. And if you did manage to act quickly and take advantage of them, your view was validated almost immediately, because there was a lot of research going around, and windows of opportunity were open on a very narrow basis. These days, we're finding that with momentum plays, once stocks pick up momentum in one direction, even though they may have it wrong, like they did with ResMed or Telstra or even Evolution Mining, that window of opportunity opens up really wide. And then you're constantly in that situation where you lean into it, you take a big position, or you increase your position, and you keep second guessing yourself as to whether you've got it right or not. Due to our fundamental approach and our cash earnings-based approach, we were able to get a lot of confidence from that. And so we've been leaning into these positions. Calcium, I have a question mark next to, because management credibility issues have been raised, and it's something that's a work in progress that we're working on. But those are the three stocks that really, I guess, cost us. And I'll come back to them in question time if there's any more questions. So from a high-level view, the good news is, as per the CFO of CBA, the big bank, his comments, so his takeaway from reporting season was the point of maximum pain from the higher cost of living for consumers could be behind us. So inflationary pressures remain, but this is a big statement. When we drilled down as to why they feel this way, the response was that, well, they get to see 11 million bank accounts, they run the analytics over it, balances have started to improve across the board, and the main reason is because salaries or wages have caught up to a reduced spending patterns. Now, obviously, the consumer can start spending again, and unemployment could kick in, but their outlook is that neither of those will happen, and that the consumer's got a new cadence to spending and earning. So our view is that discretionary sales have rebased. Costs for most companies remain problematic as wages, the flip side of consumers being in a better space is that for businesses, costs around wages continue to go up 4 to 5%, and virtually every other cost line, particularly rent, insurance, energy, continues to be problematic. And so on an outlook basis, operating and financial leverage still look problematic or negative. Our outlook is domestically, the higher rates are certainly impacting the economy. So we think the Reserve Bank's probably done, and the next move will be down. So that's a change for us. We didn't know where the next move was. We now think the next move will be down, mainly because things are going to keep getting a little bit tougher. We think it's probably next year, and globally, the central banks have started to cut. We're saying in the States, 50 basis points quite big. Doesn't mean that things are great. It just means that they feel like they're behind the curve. Now, interesting for us, really interestingly, it hasn't impacted the Aussie dollar yet. So the Aussie dollar's been still under pressure. And that surprises us. So it means that the investors must still be a bit negative on China and commodities outlook, in spite of what's happened over the last week. We think momentum players are rife, and we think that as always, you need to lean into high conviction ideas, and we're doing that. And we think unsupported growth-based valuations remain extremely valuable. So nothing's really changed there. Domestically, consumers have been remarkably resilient, and bifurcation is definitely widening. Employment remains key. I don't think the levels of immigration are going to help support full employment. I think that's a problem for next year. And I guess interestingly, interest rates have a different impact on those who spend everything they earn versus those who are much bigger savers and live off interest. And I'll go through that in a bit of detail. Australian immigration is supportive of housing, goods, and services. So just issues to consider. First of all, I've had a lot of questions why banks been so strong up until the last week. And I've got a couple of reasons there, and I think you're okay across most of them. The main ones are, unexpectedly low bad debts. The banks have got lots of surplus capital, and they've seen quite robust credit growth, mainly in business lending. But number 4, completion funds, has been counterintuitive and obviously makes no sense. But the very big super funds have a rule applying to them due to government regulation that if they underperform, they have to send a letter out to all their policyholders, telling them that they've underperformed and suggesting alternative investments. Crazy rule, but that's what they have to do. None of them want to do that. And so even though they're taking quite big active bets through their either outsourced or internally sourced active fund management, they now have very large funds which they're using to neutralize those bets. So most people are completely underweight CBA, but these completion funds are big buyers of CBA to try and some of the other banks to try and neutralize that. And that's creating that issue. Remember that in Australia, you've got resources and financials, the big 4 banks, as your barbells, and people typically go one way or the other. So what we've seen in the last week as resources have caught a bid, people have funded that by selling some of their financials. So that brings us into the next question, where to from here with our major commodities trading partner in China. Fundamentally, there's some big issues there. They've got a deflationary environment. They've got deteriorating demographics, so it's aging quite rapidly. There's a real loss of confidence in property, and government has pulled out all the stops in the last, well, not, I don't think all the stops, but a lot of stops in terms of creating this government stimulus. The jury's out as to whether it actually helps or not, but certainly from a very, very oversold position, the stock markets have reacted to that stimulus. So people were extremely short. Even just closing the shorts has meant a real bounce in commodity-based stocks which rely on China. Our own view is, I don't think it's really going to help. We did up our BHP and Evolution Mining within the portfolio at prices that indicated they were very attractive, but we're not relying on this government stimulus actually working. And then the third question we keep getting asked is, why is the Australian economy so resilient? We think government spending is a big, big part of that, to the extent that it's crowding out the private sector. So the public sector in both construction, big infrastructure projects, and the NDIS is certainly crowding out the private sector. There's full employment. Immigration means there's more people looking for more houses, and a very diversified economy buttressed by a floating Aussie dollar. And we can go into that in a bit more detail. I'm just conscious of the time. I'm going to go through this very quickly. This was from our friends at CBA, where they highlight these are the younger demographics up at the top, older demographics at the bottom, and you can see that home loan balances are going up, whereas deposit balances are going up in the older demographics. Spending on essentials is flat. Is equivalent across the different demographics, but on discretionary, you can see that the younger people with rent stress and mortgage stress are cutting back, and the older people are seriously enjoying themselves with this massive interest rates. I'm sure many of your clients are finding the same thing as people I've had feedback from, where the biggest single challenge for a financial planner these days is how to keep your clients within the right bands for government pensions. Okay, this is just a quick slide to show, everyone's talking about bringing down immigration, but we're at very, very high levels, and I suspect that they'll bring it down if they can, down to COVID levels. All right, stocks in the portfolio. I'm going to go through these in about 5 minutes, but if you think that population growth is good in Australia, and it is good, we're at top of the table across the Western world. You want to think about building or housing, companies that have good, strong subscriptions or discretionary consumption. We've sold our CSR into the bids. We've made a ton of money out of that. Moss Group's been very good. Stockland's been very good. Mitre 10 is buried within, it's 50% of earnings of Metcash, where we've got a big position. And Metcash is on a 12 PE. So, it's one of those stocks we really like. On subscription services, as population grows, obviously Telstra on their mobile phone business, they've been winning lots and lots of share. NIB as well. And obviously discretionary retail's done exceptionally well for us. We made a ton of money out of JB Hi-Fi, and we've sold that, and we've done exceptionally well out of these other two discretionary retailers. I must stress that we've halved our positions in these two companies that we still have, as the multiples have gone up, and you now need to rely on a reasonable consumer rather than not having to rely on the consumer. So I think the easy money's been made there. You also want to be in lowest cost producers. So BHP and Evolution is where we sit quite comfortably. We can still get a 10% plus after tax cash earnings yield from BHP, even if the iron ore price drops to $80. Medibank, given its scale, CSL Behring, given its scale in plasma collection, does very well for us. And then within the telcos and the banks, certainly producing a widget of mobile phone data off their massive network works very well for Telstra. CBA, I had to put it up there because they really are the lowest cost producer of home loans and have the lowest cost of funding in home loans. NAB does the same in business banking. That does not mean that I can make the Commonwealth Bank valuation work, and we have significantly reduced our holding there. You can read into that what you want. And NAB, we've taken quite a bit of money off the table. So the banks are really expensive. Remember that the value of long duration assets goes up when the cost of money goes down, and vice versa. I like showing this chart, as I've shown for the last 4 to 5 years. If you look at where we are now, I think the cost of money is about right on a long-term basis. It'll probably come off a little bit, but we're not expecting a massive decline. There is the fund. There have been some changes, still very defensive. Financials are sharply reduced portion of the portfolio due to the big reduction in banks. Consumer discretionary has been more than halved on a total basis. And interestingly, it's the first time I can remember that resources are actually above consumer discretionary at almost 10% of the portfolio. We have quite a high cash level and no put options. And the one thing we think a lot about is, what happens if interest rate differential globally does change? What does that mean for US dollar, holdings where we've got CSL and ResMed? BHP is really a US dollar holding, and Aristocrat and Evolution Mining. Multiples are quite elevated. It's something we think about a lot, particularly financials is at a very high level. You've got CBA and even Westpac is 2 times book value. CBA is at 3 times. We think they're very fully priced. So I think I got through everything in the allotted time, and now throw it open to questions.
First question, Rhett, you always refer to Australia as the lucky country. Do you have any specific concerns, i.e. concerns that apply uniquely or primarily to Australia, and how are you managing those?
Yep. So I guess the first one that comes to mind is that the flip side of being geographically positioned with huge natural resources and being the lowest cost provider of these resources into our biggest trading partner means we've had a massive tailwind as China has urbanized. And is that coming to an end because there's a shaky foundation to China's growth? And so we think about that a lot. And how are we managing it? Well, other than iron ore, we don't have any exporters to China. Some would say that maybe Aristocrat, puts poking machines into Macau, but it's a rounding error in their revenues. And I want to stress that. So we are not taking a view on China and the impact on commodity prices because we can't predict them. It's only where lowest cost producer works for us. So that's the one. The second one would be housing. And as you know, we've looked at this in every which way. There is a conundrum in that we are underprovided on housing, so we're completely underdone, but mainly due to supply constraints. So whether it's planning approvals, whether it's enough tradies to actually build the stuff, whether it's being crowded out by the government. And so we've had to look quite carefully as to how do we find companies that are appropriately valued, but will participate whether there's an opening up of the bottlenecks or not. So on that side. And then the third thing is we continue to be concerned about home loan lending and the ability of consumers to continue to meet that. Because house prices have gone up so much, I think the banks will continue to have very low bad debts, but it's difficult to see growth off these levels in big home loan books. So there's a few issues that we've spoken about. I could spend all day on it. Immigration continues to be quite strong to the extent that it is becoming a political issue, and steps have been taken to dampen down immigration. But as I mentioned, we're currently at levels that are double our pre-COVID levels, and they obviously want to try and get it back to a more sustainable level. So we think we're okay on that.
And immigration, obviously, you've made the point that it is strongly supportive of the economy. How does the clamping down, we've already seen it in the education space, how does the clamping down impact your outlook on the health insurers, the building companies, that sort of thing?
Yeah. So I think, Adam, just to be very clear on that, if you're allowing 400 to 500,000 in when your normal level's around 250, you've got a long way to get it back down to your normal level. So in my view, what's happened is they opened up all the gates. They weren't very careful about people who were saying they were going to be students were actually doing, and the amount of rorts. We're hearing that a lot of that's being clamped down on, but the core underlying immigration levels are still very, very comfortable levels. I just want to try to show that in that chart, but there was a massive spike up. That is not a sustainable level. Bringing it down 30-40% is where we would like it to be, and they've got to do a lot of work to bring it down to that level. So I think underlying operating levels will support the earnings we see for the health insurers doing non-residents health, and certainly the building industry is underprovided, even not allowing for immigration, but immigration has created that political issue, so they're trying to bring it down. Hopefully that's explained.
That's clarified things. Thank you. And you made a point earlier about having very little revenue exposure to China. What proportion of the total fund's revenue is generated offshore, and can you give us a little bit of a feel for that split?
Sure. So it's something we think about a lot. Remember that my role is to create Aussie dollar unit holder wealth, because most of your future expenditure will be in Aussie dollars as clients of ours. Certainly that's the case for me. And so we think the right level, so I'll just give a bit of background. After studying this for many decades, we think the right level of global exposure for an Australian for future expenditure is between 15 and 20%. We've currently got about 30% in the portfolio exposed to non-Aussie dollar earning streams. And in that, we include CSL, ResMed, Aristocrat, and BHP and Evolution Mining. So even though they're local operations in BHP and Evolution Mining, the exports, so their revenues are denominated in US dollars, and so we include them. Now, I will stress that more than 50% of the Aussie dollar, of the Aussie exchange is exposed to non-Aussie dollar earning streams on that basis. So we're quite underweight that. A fair chunk of that is New Zealand dollars, so about 5%. And so our exposure is quite reduced. I have a view that the Aussie dollar's undercooked, but trying to make money out of currency is really hard. However, we've certainly taken steps to reduce our exposure to non-Aussie dollar earning streams.
Great, thank you. Interesting question here. Do you think the proposals around bank hybrids could lead to greater demand for the stocks that pay large, fully franked dividends?
Yeah, that is really an interesting question. Look, I think there's always going to be a huge amount of people searching for secure income. Hybrids have been a great source of that, and a very efficient way for the banks to fund their books. Can I maybe just add a thought process to that question, is that there's no doubt in my mind that hybrid instruments are about 40% as attractive as they used to be about 3 to 4 years ago, because the rules on them were changed so much, and the banks have changed the risk, where the risk lies, shifted it completely to more with the hybrid holders. So any taking out of large amounts of supply in one feature will obviously force people to look elsewhere for it. How successful they will be, I don't know. Can I just stress that maybe hybrids were over-indexed because they were so attractive in the past? People haven't realized how unattractive they've become. So I think fundamentally it doesn't really matter, but yeah, there will be a pot of money looking for other places. And yeah, so maybe, we keep finding stocks now that 8 or 9% fully franked dividend yields. Hard to understand why earnings will get crunched to the extent that to make them unattractive. And those are those nuggets of gold we keep talking about.
Makes sense. Question here on the views on valuation multiples in the small cap space.
Small cap. Sorry, that's a very wide question, so I'll try and answer as much as I can. First of all, small cap space is incredibly varied, and so it always depends on whether resources are attractive or not, or financials are attractive or not, because they have such a big impact on it. We are finding at the smaller end of the mid cap, and particularly in the small cap side, lots and lots and lots of very low multiples. And there is a bifurcation. So if you think it's got lots of growth, the growth managers are all over those stocks, and actual cash earnings become irrelevant. It's just thematic investing, in my view. But I'm pretty conservative and I like cash, so you'd expect me to say that. But there is, if the question is, are there lots of opportunities worth looking at in the small cap market, I would say definitely.
Right, that's comprehensive. We have always thought of Evolution as a gold miner. You raised their copper production. How big is that as a proportion of their total business? Because obviously everyone knows that copper is going to be very important to the energy transition.
Yeah, so it is at least 20% of earnings, and growing. And can I just stress that it depends on the copper price, obviously, because that's been quite volatile of late. But as that's gone up substantially, it's a big piece. Can also just say that the way the mining industry accounts for this byproduct of copper within the gold mining industry is they count the income from copper as an offset against costs rather than separate. And because you're producing gold and copper from the same mines, it becomes hard to work out what percentage of actual earnings are copper, because you're not ascribing a income after expenses to the copper bit. So you just say as percentage of revenue, and that's what I'm referring to.
Question here. Would you be able to talk around what you're expecting with Aristocrat's strategic review of mid-core gaming assets and the likely use of that capital if the end is a sell down?
So can you just repeat Aristocrat's which assets?
The strategic review of mid-core gaming assets and the likely use of the capital if it results in a sell down.
Yeah. So they're always reviewing their portfolio. They've got a lot of assets. I'd actually have to take that question on notice. I'd be guessing to try and answer that one. Mark is the expert on that. I wasn't aware there were any assets of particular size that they were looking at selling. Can I just also make the point that Aristocrat their balance sheet is incredibly fat, and they certainly don't need capital. And the cash flows generated out of their business are absolutely enormous. So, yeah, I mean, I suspect it won't be a big issue, but I could stand to be corrected.
Perfect, thank you. You have reduced your exposure to banks and consumer discretionary. Resource exposure is higher. Has most of the additional capital from banks and consumer discretion gone into resources, or have you been allocating to other sectors as well?
No, we've definitely been allocating to other sectors. So when I say lean in, we absolutely allocated more capital to. We got a couple of bites at ResMed, which has been very successful. A couple of bites at Telstra, and then things like Stockland, where we built a really good position. Mars Group, and then bear in mind that CSR was taken off us at an exceptionally good price, and then we've been reallocating some of that capital to opportunities. We've also started, a couple of other positions which are still small, and we're in the process of building them, so we don't talk about them, but there have been a number.
I have a question here about ResMed's recent Investor Day. If you had any major takeaways from that, and at what point you would view ResMed as fairly valued?
Yeah. I will stress that ResMed's probably, all the years that I've covered it's at the cheaper end now, and it's hidden to some extent by the fact that it's got lots of cash. So it's made a few big acquisitions, and now that it's repaid all the debt that it had, and it's cash surplus. So it just goes to what a very strong business it is. I guess two things that were the big takeaways. We've been chasing these numbers down for some time. They've never disclosed how many devices they've got connected to the net before. So if you use your sleep apnea device and you wake up in the morning and you hit a button, it uploads the sleep data up to the cloud. More importantly, I want to know how many of those machines they've got out there, because on average, people replace their masks 2 to 3 times. And if there are 26 million connected devices, that is an enormous annuity stream. And bear in mind that the masks make up about 30 to 40% of the sales, but have an 80% earnings margin, or 90% earnings margin, a gross margin. So we got hard data around that out of the investor day. The second thing is, very powerfully, they were guiding, they weren't guiding before, but to 10% revenue growth for the next 5 years, and higher with operating leverage, so higher than 10% earnings growth. And we've had that in our model, but that's now been validated. Yeah, I mean, there are lots of other issues, learnings that came out of the Investor Day. Anybody interested, I highly recommend you watch, particularly Mick Davis's one. Mick Farrell's presentation, because it's only about, I think they only allowed him about 20 minutes because he likes to blather on like I do. But he got through a hell of a lot of information, and it's on the ResMed Investor Relations page, and it's right at the start, so it's quite easy to find.
Great. Last question, and this one's actually from me. The market environment has obviously changed considerably over the last couple of years, but your messaging and how you talk about stocks all sounds very much the same. So Just wondering if there have been any changes to your approach, what you look at, the type of companies, or even how you construct your portfolio.
Yeah. I mean, the short answer is no. Nothing's changed. We still looking at the cash. We're still worrying much more about who's got the balance of power in every negotiation as an indication as to the certainty of those future cash flows. If I had to find or determine one thing, it's been more due to market structure, and it refers to that window of opportunity that I spoke about earlier, which is there's so much momentum and so much index or MSCI, benchmarking that goes into play with the hedge funds and the quant funds, etc. We're finding that those windows of opportunity stay open to the extent that you really have to be a high conviction, because stocks can move with momentum a long way before fundamentals catch up. And it's having that courage of conviction. And so maybe, and the one thing that's changed about maybe how we construct our portfolio is we're a lot more aware of having balance to the portfolio, because you can't have all your eggs on the one side, and then if momentum goes against that, there's only so much downside risk people will tolerate. And so by balancing that up, we found we've found a much more stable performance level. And while you're waiting for one side to correct itself, you're making money on the other side. So I think maybe we've got a little bit smarter in that, but nothing else has really changed.
Okay, so a few changes on the edges, but I suppose the more things change, the more they stay the same as well. So that's some good perspective. I think in the interest of time, I am going to wind up. Thanks to everyone for joining us. Thanks also to those who submitted questions. I think that there were some excellent ones. And there are still a few questions that we haven't responded to, so we will get back to you directly. But obviously, if you have any other questions that you didn't ask during the webinar, please get in touch and we will respond to you. We'll get back to you. I'd love to hear from you. Our next webinar is actually this time tomorrow. It's with James McDonald, the portfolio manager of our High Conviction Equities Fund. That has really been a sensational story of late, so you can register for that on our website. To any Jewish people who joined us on the webinar, Shana Tova and Happy New Year. And to everybody else, thanks for joining us and enjoy the rest of your day.